only. Chapter 16. Chapter 16 says managing, monitoring, and mitigating risk. So we 16 chapter also we will be studying about risk management only. Okay, then what are the risk management strategies? The roles, risk awareness, risk monitoring, and risk assurance mapping, and the 4 lines of defense. So these topics, the first one, see out of these topics that are given in the previous slide, okay, what are the roles in risk management? The role of the board. Role of the board, okay, a business strategy, what the company wants to do. So at the strategic level, we see that the strategic level is involved in planning for the entire organization. So business strategy, what the company will do. See, in terms of managing the risk, what is the role of the company? So that's decided. And based on that, see what will the company do, what the company wants to do, and look at what is the risk appetite. Appetite talks about how much of the risk that is present they are ready to accept it. That's the appetite which we talk about. See, if there is risk present, do they want to take up risk or they do not want to take up risk? See, not everybody thinks in the same manner in terms of risk. For example, see, uh, yesterday when I raised the question, some of the students have come forward saying that we do invest in the stock market. Okay. Um, some of them may not, they may just dislike the idea of investing into stock market. They see that, so this is so risky. Why go ahead and invest in that? See, it is the attitude of two individuals. See, both of them are right in their own perspective, the way they think. See, generally in families, we see that in the family, we see that if somebody is thinking of an investment, usually the younger lot people, they prefer to invest in like these investment opportunities, risky investment opportunities like stock markets, real estate, investment into foreign currency, gold, precious metals, etc. So that is the attitude what we see. The older lot of people, the seniors in the family, they feel that the amount should be invested in banks, post office, national schemes, government bonds, etc. Each of them have their perspective there, their opinion there. So the ones who think about accept the risk is based on high returns. Some those that do not want to accept risk is to safeguard their investment amount. So each one of them have a perspective and they have a particular appetite to take up the risk. So what is the company's appetite has to be looked into. Risk appetite, how much risk the business will accept. But just because profits are to be maximized, they cannot keep on accepting risky investment decisions or risk decisions involving risk. They cannot accept them, but that is how much will they be accepting is based on two parameters. One is the overall attitude what they have towards risk, and the second one is risk capacity. See, an individual wants to invest in stock market or something like that, or generally we see that an ordinary person thinking about investing into real estate. See, when there are fluctuations, in the stock market, if they are hit by the risk, if they get affected because of the risk, can they bounce back and survive in that situation? See, sometimes when we talk about risk, there is every possibility that there could be a negative situation also present. If we say that the returns are high, we also indicate that yes, in those situations, sometime or the other, they may also can get affected because of the negative impact. There is a negative impact also all the time present there. See, sometimes they may get hit by that negative impact. If they are affected in a negative manner, can they survive? That is important. So the business also, when it accepts the risky projects, what is the amount of maximum risk that the business can accept? So to what extent is it ready to bear the loss? That talks about the capacity. Okay, it is just not about somebody's desire, somebody's will to take up something. It is also the ability to face a negative consequence. So taking these two things, what's their overall attitude is one important aspect. See people, those that have too many funds, also companies that are very well funded, their position is very sound, profitability wise they are very good also. We see some of the organizations do not take up risky decisions, they do not invest in risky investments. That is their attitude. Some entrepreneurs, sometimes we see the startups, when they come, they may not have that capacity to invest into risky projects, but yet they still do come forward and invest into risky projects. What is the reason? It is the overall attitude, their overall attitude towards accepting the risk. Then we look at what is the capacity. Capacity is what's the maximum amount of loss that they can bear or risk that they can bear. Taking these two things, it will be decided about what's the risk appetite. Risk appetite is how much risk the business will accept. Okay. Now, once the risk appetite is known, now then risk strategy will be framed, how risk will be managed. So once, depending on what is their appetite to take up the risk, now when the risk is there, it is just not that they accept it and wait and watch. It would not be the case. They knowingly accept the risk, but also put in effort to manage the risk. So some measures would be taken in terms of reducing the impact which is there on account of risky events. So risk strategy would be there, how much risk will be managed, and business strategy, what the company will do. So ultimately, um, achieving their overall objectives. Okay, so that is the roles in risk management. What is the role of the board? Board at the senior level, at the strategic level, what is the role of the board of directors in terms of managing the risk? The last committee, yesterday we've learned one committee. The previous days we've learned the other committees. So the fourth committee here is the risk committee. Okay, what are the other committees? Do you remember what are the other committees? Until now, we have learned three committees. This is the fourth committee. Any one of you? At least one? At least one? Very good. Nominations committee. Then I got one student answering nomination committee. Yesterday, what committee did we learn? Nomination committee is to nominate the executive and the non-executive directors. To them, remuneration is to be paid. So therefore, there is a remuneration committee. Then the audit work has to be carried on. Therefore, there's an audit committee. The fourth committee here is nomination committee. The fourth one is the risk committee. Okay. Now, what's the role of risk committee? There are four committees: nomination, remuneration, audit, and risk committee. Risk committee update company risk profile and appetite. So they would be looking into the risk management. raise risk awareness. Awareness is in terms of communicating the information about what are the possible risks that are present, and then how to manage that, or anything related to that particular thing. So gather all possible information and then communicate to them. So that's about the risk awareness, raise risk awareness among the employees of the organization. Implement process to monitor and report risk. Okay, as things are implemented, keep monitoring and then give a feedback also. Then establish policies for risk management. So the roles of risk committee. What's the role of the risk manager? The risk manager is a member of the risk management committee, reporting directly to that committee and the board. Focuses on implementation of risk management policies. Manager is supported and monitored by the risk management committee, monitored and supported and monitored by. Then role is more operational than strategic. But who decides the strategic role? Who's the one who's there to take the strategic decisions about the risk? If you're talking about the risk manager's role is operational, so someone has to look into the strategic part of it. Who looks into the strategic aspects of risk management? Today we have learned it. Who looks into that? Few minutes back we have discussed that. Today's class only, few minutes back we have discussed. Whose role is that? The strategic role is played by any one of you. Please answer. Look at the screen and tell me whose role is the who plays the strategic role here. Okay, fine. I will also not ask questions. Okay, then we have risk awareness. Risk awareness happening at the three levels of management: the strategic level, the tactical level, and the operational level. So, strategic level, high level monitoring of risk. Strategic level is the top management. Then tactical is the middle level monitoring of risk at divisional level, because the work is assigned by the middle level to the departments or the individuals in the organization, how the work has to be carried out. So therefore, they monitor the activities at those levels, at the department levels. Okay, then we see the final thing is about the operational at the low level, at the bottom level. The plans that are prepared are implemented by the operational level. So it says that monitoring of risk in day-to-day operations, that is day in and day out, whatever they encounter, whatever risk they encounter, to deal with that. So that the risk awareness is at the strategic level, it will be overall. As I mean, it is understood that the top management will be looking or monitoring things at an overall basis, high level monitoring of risk. Then we see at the tactical level, it is at the divisional level, the monitoring of risk at the divisional level, and operational because they are involved in implementation. So They do encounter the risk on a day-to-day basis, and then monitoring of risk in day-to-day operations. See, whether it is internal control, whether it is risk management process, it is mentioned that they have to be embedded into the organizational activity. Should not be looked at as a separate activity, but it has to be embedded into the organizational activities. So the aim of embedding risk management is to ensure that it is part of the way we do business. Considered at two levels: embedding risk in systems, embedding risk in culture. Into the making it as a part of their system, or at the organization level, or embedding risk into the organizational culture. So in the system, it is included within the control systems, then ensure the other systems are working correctly, not seen as a separate system. Embedding risk management needs approval and support from the board. If it is to be embedded into the system, needs the support of the board of directors. In many jurisdictions, there is a statutory requirement, while in others, it is code of best practices. See, in the US, it is rule based. In the UK, it is principle based. So, principle based corporate governance follows the corporate governance code of best practices. So, that's how it is ensured that the risk management system is embedded into the system. See, rule based talks about SOX. Principle based talks about what would be the role of the board of directors, what will be the structure of the or who would be comprising the board of directors, what is the structure of the management. Then we see that there are executive directors, non-executive directors. So the board that is supporting the management decisions. So we see the structure of that in case of code based principles. So what's the structure based on principles? We looked into that. Rule based, it is about having different laws. The one which is there in our syllabus is about SOX. Okay, to look into that the risk management system is embedded into the systems, into culture. Bring about that awareness, let everyone know that it is what they believe in. So needs to be embedded into policies and procedures, so they understand that this is how it happens in the organization. So everybody will have that awareness that this is the way in which they have to deal with a particular situation. So all workers in a company accept the need for the risk management, then embedding into culture and values therefore implies that risk management is normal for the organization. They understand that this is the way they carry on the active with the activities. So they understand that part of it, because they're already told about what is to be followed, what is the culture, what are the policies and procedures that are followed in the organization. So it is embedded into culture. If it is embedded into the system, the board of directors have to give an approval about that. It is embedded into the system along with the regular activities. These things are also implemented. So they ensure that the other systems are working properly, and it also goes along with the regular operational activities of the organization. Culture, it is about making them aware about what they ought to do. So it is conveyed to them in the form of policies and procedures. Just now we've looked into the risk mapping and risk management strategies. There are 4 strategies: transfer, accept, reduce, avoid, based on a combination of impact of the risky events, and then the probability of happening of the events. There are other risk management strategies also. The other risk management strategies, today is Friday, isn't it? Friday. We have class on Saturday. Do we have class on Sunday? Saturday, Sunday. Next week, we have another two. Maybe in the after the break, I will work out one small, very small case study on risk mapping. A small one will do, because going on so dry, so much. So maybe we can fit into the class one small case study on any one of the topics. So other risk management strategies are um, alarm as low as reasonably practicable. The as low as reasonably practicable principles. So the alarm principle expresses a point at which the cost of additional risk reduction would be grossly disproportionate to the benefits achieved. So risk management. I mean, what is the process of risk management? First, identify the events, then understand what's the impact of it, then take up a decision about or have a response. Once it is understood about what are the different types of risk, what is their response, whether they have to start a framework, so that whether they have to take it up or accept it, avoid it, reduce, or transfer. So there are certain steps involved in the risk management process. Now, risk management process is a continuous process, because continuously they have to keep monitoring and then understand what are the risky events. See here, everything has a saturation point. See, risk management also, they cannot keep on putting into that efforts, funds, cost, because the maximum benefit what can be derived by having a risk management process also can come to a saturation point, beyond which there would be no more benefit that can be derived. So here it says that alarm principle expresses a point at which the benefit benefit does not exceed the additional cost that is incurred. Okay, would be grossly disproportionate to the benefits achieved. So this principle is usually applied to safety critical high integrity systems where health and safety risk cannot be eliminated. Example, oil risk. So since in situations where um, when it comes to a point where the benefit that is derived does not exceed the cost, in that case it will come, I mean, that would be the peak point where it would be stopped. But in certain cases, here there is an example given. It says that in case of health and safety uh, risk that cannot be eliminated in some of the industries. So even if the benefit that is derived doesn't exceed the additional cost that is incurred, additional benefit does not exceed the additional cost. In spite of that, also they still do take up invest into the strategies about managing the risk. That is alarm. Think about diversifying or spreading risk. Diversification, risk management, risk reduction strategies involve diversification and spreading of the risk. Okay, what does it mean by diversification? See, there's a saying that do not put all your eggs in the same basket. Why? If something happens to the basket, all of them would be lost. Therefore, it is advised that these eggs should be spread into multiple baskets, so that even if one basket gets affected, the eggs in the other baskets are safe. So also when they are investing into their amount, um, if if they are hit by a negative impact, that would be drastic. So therefore, it says that risk can be reduced by diversifying into operations in different areas, such as into industry X and industry Y, or into country P and country Q. So spreading out the investment amount and investing into multiple investment avenues. By doing so, see if there is a loss in one from one investment avenue also, they still would survive because there would be profit earned from other areas, other divisions, other businesses. So that concept is called as diversification or spreading of the risk. See, if, just because it's something looks very attractive, do not put all the funds in that same investment opportunity, but rather divide these investments into multiple divisions, and then each of them should be spread into multiple investment opportunities. If one is affected, also still there are other investment opportunities which can support that thing. Okay. Poor performance in one area will offset by good performance in another area. See, even if there is loss in from one industry, one investment opportunity, but they still can manage because there is profit from another sector. Diversification is based on the idea of spreading the risk. The total risk should be reduced as the portfolio of diversified businesses get larger. Example of a poor diversification. Swimming costumes and ice creams both reliant on a sunny weather for sales. Swimming costumes, swimming is taken up during summer seasons. Ice creams are also bought in summer season, mostly bought in summer season. The demand for these products is high in case of summer season. So why invest into such kind of things? But rather during the other seasons of the year, okay, during other times of the business, we see that something else can do well. Therefore, divide the investment amount and invest into diversified businesses. Spreading risk relates to portfolio management, where where an investor or company spreads product and market risk. That is just not facing the risk by investing into only one investment opportunity, but by dividing this and spreading the investment amount across multiple investment opportunities. See, even if one area there is loss also, and the other areas would still be doing good, and they can survive or manage with the profits earned from other areas, other investment opportunities. What is risk monitoring? Risk audit is a systematic way of understanding the risk that an organization, these are all very general, organization faces. So there is an audit with specific reference to risk to ensure that things are implemented appropriately. So risk audit. Unlike financial auditing, risk audit is not mandatory. Only financial statement disclosure is mandatory. Financial audit is mandatory. Any other thing that is taken up is all optional or not mandatory, but these they're still taken up because the benefit that is derived out of those activities are more to get benefited out of those activities. We see that these things are implemented in the organization. Um, is not a mandatory requirement for all organizations, but in some highly regulated industries, a form of ongoing risk assessment is to be taken up, and audit is compulsory in most governing jurisdictions. Some organizations employ internal specialists to carry out the risk audit. Others utilize external audit. What are the stages of risk audit? We see a process for carrying out internal risk audit. starts with identifying the risk and construct risk register, the one which I was mentioning about it. So prepare a risk register, construct a risk register into which the data related to risk is all entered. So there is it's kind of a database that is created which has the details about different types of events, the risk that they cause, into the risk register. Sorry about that. What are the stages of risk audit? Risk audit, first step is to identify risk and construct a risk register. Based on that, the ones which are inadequately controlled have a report prepared on that. See, when the risks are identified, assess risk by applying the probability impact assessment. Already we've learned about how to calculate that. Apply that. Then, if there are risks that cannot be controlled, if they cannot be managed, we call them as, there's a term called as residual risk. Residual risk, those that cannot be managed. See, even after managing the risk, if some amount of risk is still present, we call that to be as residual risk. Okay. Report on inadequately controlled risk. Then review controls over risk which involves TARA, either transfer, accept, reduce, or avoid it. Then we have an assurance mapping and risk management. Assurance mapping and risk management. What does it mean? Assurance mapping and risk management. See, there is a presentation of assurance mapping. We see that there are multiple blocks or boxes like thing. Then it also talks about there are certain things that are mentioned here: first line, second line, third line, fourth line. But let's first understand about what is this concept. And here on the vertical aspect, we see financial reporting, financial controls, etc. There are many, there is a list of things given. Then we see high assurance, medium assurance, low assurance, and then um, no assurance, not applicable. Okay, there are different categories there given here on the assurance mapping. Okay. So what does it mean by assurance mapping and risk management? So it says that assurance is an objective examination of evidence for the purpose of providing an independent assessment. We are looking at what's the concept of assurance mapping. In this case, assurance map is a structured means of identifying and mapping the main sources and types of assurance. There are different lines. The first line, second line, see under first line, we see control framework, management review. In the organization, we see that there are certain functions of the business areas where um, what is required. See, here on the horizontal axis, we see that high assurance is required for financial reporting in the first line in terms of control framework management review. So it is a presentation about each function, what is the type of assurance that is required or it is not required at all. So there is a map that is prepared in terms of giving an assurance about how the risk would be presented, and after it is um, depicted on the assurance map, the areas where high assurance is required, medium assurance is required, low assurance, absolutely no assurance, or things are not applicable in each of these functions of the business will be presented here in the assurance map. Assurance mapping. Assurance map is a structured means of identifying and mapping the main sources and types of assurance in an organization across the four lines of defense. Under each line of defense, what is covered is also given here. See, under each line of defense, we see first line has control framework management review. Second line has control self-assessment, risk and compliance, group legal, board review. Third line is about internal audit. Fourth line is about external audits and other third party audits. Okay. So in each area for each function, what is the kind of risk management or what is the kind of assurance that is required, so that later on when the risk management process starts, their focus can be on those areas where there is a, a need for managing that risk, so that that can be identified. So there is some amount of assurance. High assurance is given in these areas. Medium assurance is given in these areas. Low assurance is given in these areas. So it is about presenting what is the role of each of these functions of the business and what kind of an assurance is given under these four lines of defense. So that's a graphical presentation about assurance mapping and what risk management process would be taken. An assurance map shows key elements over which assurance is required. This will change depending on the type and size of the organization. There are four lines of defense. Then identify any gaps which where no assurance limited or not provided at all. So I think things when they are presented, if it is visually presented, if there is visualization, dear, see, why is that anything is presented using visualization tools is to have a better understanding about that. No matter what the theory and what the text explains, also it is not as effective as when it is presented on a visualization tool. So assurance map is also visualization tool wherein it talks about, see, what are the areas where there is high assurance, what are the areas where there is low assurance. Sometimes it is not applicable in that particular area, so that when it is presented it becomes easy to understand. It's kind of a prioritizing what are the areas where it is very well assured, where it is not assured. Okay, so then what course of action or what management risk management policies can be decided about that, and then how do they manage that? Then again, a general topic about what are the benefits of assurance mapping. Provides a basic on which to communicate with stakeholders. See, because things are all clear, where would they be putting their focus on, how, which area the risk management strategies will be working, the areas where there is high assurance, so need not be worried about. Everything is presented here on the visualization tool, so it's better understood once the priorities are clear, and then how are they managed. So provides a basis on which to communicate with stakeholders and begin quality conversations, because there are benefits for each of the groups that may make use of the map. Together they should enable the board to make more reliable um, and robust reports to its stakeholders. See here, what areas they can work. See, this is all very general about what would be their strategy in terms of managing those risks. How would they focus on that? How would they manage that? See, then anything to be communicated to the stakeholders, what would they do about communicating? See, because there is a assurance map available, because all the types of risks, and in each of those four lines of defense, when they are presented there, it gives an understanding about which ones have to be managed first, prioritize them, take up the course of action, and then manage those things. Then how are they managing that, or what course of action is taken, also can be communicated to the stakeholders. So that's about risk mapping, assurance mapping. What are the four lines? The first line says the way risks are managed and controlled day to day. Benefit is assurance comes directly from those responsible for delivering specific objectives or process. Then it may lack independence, but its value it is that it comes from those who know the business culture and day-to-day challenges. Second line, the way of the organization oversees the control framework so that it can operate effectively. So it's just about explaining what are these lines of defense. The first line, the second line, under that what is there. So what do these lines indicate? Indicate about how risks are managed and controlled day to day. Then what's the framework, control framework, so that it operates effectively. The third line talks about objective and independent assurance. That is about the internal audit, the activity that is carried on. Fourth one is about the external audit, assurance from the external independent bodies such as the external auditors and other external bodies. Please have give a read through what is an assurance map. Very well explained in the study text also. There's nothing difficult point which is included. It's a very generic thing. Generally, when it is studied, we can understand. It's only that there is a visual tool present here to um, categorize them and then prioritize the areas where risk management is required. So present them in a way in this particular assurance map. So where we see that some areas in some of the functions, there is no need for any kind of additional effort to be put in, because there is already high assurance. Some of them there is absolutely no assurance, or some of them can be, some of the activities can be absolutely irrelevant. Okay. If it is financial reporting, anything to do with group relevant, group legal is irrelevant, or third party, other third party audit to happen, that may become irrelevant because there is already an internal audit, external audit. So there are certain areas where it becomes completely irrelevant. Another example is legal under control self assessment. See, if there is control self assessment, on that legal action need not be taken, isn't it? So that's how we identify, understand that, understand the